Hey, Gerry, good morning, everybody. Welcome to the retirement planning breakfast here in Wasaga Beach and also on Zoom, anywhere in the world. We have people all over the world tuned into this. Well, maybe not that far, but we definitely have people on Zoom. I'm David Grossman. I'm a mortgage broker, a dealing representative, and a musician. This is my friend Gerry Hogenhout. He's an accountant. He's also a financial planner, and he runs a company called Canadian Investment Services. And we have worked together for some time doing seminars like this. We've done some before at the Hive and elsewhere, but the Hive has been very hospitable, and we're very happy to be here. If you're here in person, it's a $5 breakfast. My wife is taking the $5, and Gerry and I are subsidizing the difference, and that's the plan. So let's talk a little bit about what we are going to be presenting today. Retirement planning, obviously, that's the key. Gerry's going to be opening things up, talking about that, and he's going to be talking about how to pay less tax. Is there anyone here who likes paying tax? Yeah. No, nobody. How about online on the Zoom? Anybody likes paying tax? Okay, good. So you're in the right place. Nobody likes paying tax. I'm going to be talking about accessing equity in your home, mortgages, and mortgage investing. We're going to be talking about real estate investing, different ways that you can invest in real estate, whether it's apartment REITs, mortgages, and possibly other projects. So that's what we're talking about today. We also have a guest, a friend of ours. She and I have been doing seminars for years together. And there was a lady by the name of Letitia Montana who moved to Mexico during COVID, and she's visiting today. I think we are expecting her. She's going to talk about. She should be coming along before long. She's towards the end of the presentation. She's going to be talking about different condo projects in Playa del Carmen. That's where she's living. So that should be interesting as well. And that's the plan. So I think I've covered everything in terms of overview. Are there any questions so far? Any logistical questions? All right, good. So breakfast will come around and be served to you while you're during the presentation. If you have questions, you can let us know. If you're on Zoom and you have a question, please, yes, you can get a recording of it. If you're registered, you will get a recording. Uh, and um, and if you have a question on the Zoom, you can just put it in the comments if you would, please. And that's it. So without further ado, I give you Gerry Hogenhout.
Thank you, David. Thank you for David is Mr. Organizer. He organizes all these events, and we're very appreciative of it. And I always welcome coming out, sharing financial information. I love doing these live webinars. We do too much on Zoom these days, but hey, welcome to our Zoom crowd. Doing these webinars up or seminars up here in Wasaga also gives me the opportunity to come up here. We've been cottaging up in Wasaga for 40 years, I think. So we love coming up here. Can't wait to move up here at some point. Get out of that city hustle. But for now, we just come up here as often as we can. So as David said, we're talking about retirement planning. And that's a nice fresh break for me. Usually I'm doing tax seminars. So it's nice to actually talk about something different. And it is something that we do in our company. So David said so I'm a public accountant. I'm a chartered professional. We registered across Canada. We do tax returns from coast to coast. But we also have a company called Canadian Investment Services, the CIS Financial Group, where we do money management, investment management, financial planning, retirement planning that we're talking about today, estate planning. So when we talk about retirement planning, we're really also talking about financial planning and estate planning. It's all integrated. And we differentiate that. Financial planning, that's what we do today. Retirement planning is planning for tomorrow. And estate planning is, we all have a finish line. And we got to deal with that. And more attention should be paid to our estate planning needs and solutions. I always ask the question and yet to get an answer. The question is, how much tax are you going to pay when we hit the finish line? And nobody knows. Nobody really deals with it. And it's an important topic because, as David said, I'm Mr. Pay No Tax guy. I hate paying taxes. Everything we do in our tax practice is geared towards lowering the tax bill. And that's all part of estate planning, retirement planning, financial planning. So it's all very integrated. So financial planning, retirement planning, estate planning, it's all integrated together. And there's something else that's really integrated in your life, and that's what we call investments with your tax life. That's really important. And what I mean by that is what's going on in your tax life has to make sense with what's going on in your investment life, and vice versa. What's going on in your investment life needs to make sense with what's going on with your tax life. And most people, that's not happening. And if it's not happening, we call that financial leakage. Financial leakage basically means you're paying too much tax because whatever's going on in your tax world isn't integrated with your investment world, and what's going on in your investment world is not integrated with your tax world. And I don't know why more companies don't offer both services. We do. That certainly ensures that we integrate what's going on with your tax life and your investment life. But too many people go to their accountants over there and their investment people over there. And these people don't talk. They don't integrate what they're doing together. And we see all kinds of mistakes. I can pretty well assure you anybody that there's the accountant over there and the investment person over there, if I have a look at everything, there's stuff that's missing. You're paying too much tax. You have financial leakage. So when we talk about retirement planning, one of the things that we really want to do is use the tax system to our advantage. You know, we all know it'll take forever. So we want to use that to our advantage. And one example, there's a whole bunch of examples beyond the scope of what we're talking about today, but one example that really hits home a lot is RSPs. And that's the investment side of your life. As we look at the tax side of your life, RSPs were, I hate them. Okay, and I'll be quite blunt about that. And why do I hate them? Because I've done over 600 final tax returns. And half of those tax returns, we've sent 30, 40, 50% of the money to CRA. And one of the main culprits is the RSP. So we're programmed. We're getting our advice from propaganda, from the banks. Put money into RSP, put money into RSP. Okay, the one message I want to say is RSPs are not an investment. They are a tax tool. Okay, so we don't need money in RSPs to retire. We need money to retire. And it's best to be outside of the RSP. Because the RSP wouldn't be taxed. So that's become a real issue. And that's again, when I say the integration of your tax life with your investment life, that's probably the easiest thing I can use to describe where the real problems are. There's a whole bunch of them. So for example, we use RSPs as a tax tool. And what I mean by that is you get a tax break going in and you got to pay tax going out. So our personal tax rates, right, in simple terms, 20%, 30%, 40%, 50%. There's our tax bracket. And they go in $50,000 increments. Your first 50 grand is taxed at 20%, your next 50 at 30, your next 50 at 40, and your next 50 and beyond is at 50%. So in a perfect world, we want to put money in at 50%, save 50%, and pull it back out at 20%. That makes sense, right? That's pretty simple. We could beat the tax system by 30%. And that's what we should be doing. And that's what we do. And most people don't do it. We do keep plowing money into their RSP. And, it's not everybody that's going to get a problem with this, but most people are pulling it out at a higher tax rate than what they're putting it in. Which makes no sense. The tax system just beat you. Okay, so we do a lot of what we call RSP meltdowns, which is let's pull the money out of the RSP. We don't have to wait till we're 71. 71 is the age where we have to rip it. We want to pull that money out of the RSP whenever we can at 20%. Whether you're 40 years old, 50 years old, 60 years old, if we can pull the money out of the RSP, we will do that. And there's a lot of ways that we can do that. I don't want to go into all the different ways, but one of the most common ways, certainly for realtors, is if we can operation, then we basically don't take any money out of the corporation. We pull it out of the RSP instead to start melting down that RSP. So that's just one strategy that we do. So as I say, there's a lot of integration between the finance planning that goes on in your world, the investment, the retirement planning, and the estate planning.
Carol.
And there's another thing that it's a concept that I always kind of explain to people, what kind of helps illustrate the integration of everything is tax is a byproduct of income. Okay, we have income, we got to pay tax. Income is a byproduct of a bunch of items. Okay, our business, if we work, we get a T4, that's our income. Okay, the work brings us income, the income we have to pay tax on. If we're self-employed, same thing, that brings us income, we have to pay tax on. If we're self-employed, one of the tricks is to make sure that we deduct everything that we can, get that net income as low as we can, and pay less tax on it. Government income, if we get old age security, Canada pension, EI, that generates income. Now we got to pay the tax on. Then, but the other big thing that we all have that creates income that results in tax is our assets. Okay, the things we invest in. Okay, so we have to be, that's kind of what we're focusing on here, is the assets create income, and the income we have to pay tax. And each of those categories we kind of look at separately, and that's where the whole integration of everything comes in. So when we look at the assets, excuse me, we look at the assets, we think of what type of income it generates. Okay, there's different types of income that different assets bring. Okay, probably most commonly we have interest. So if you're invested in bonds, we have interest. We can also invest in stocks where we have dividends and capital gains. So all those bring different types of income, which when we carry that over to the top side of the equation, have different types of risks that is applied to it. We also have something that generates no income and no tax. So we're going to talk about that a bit. So again, we focus on the assets and we realize conceptually that generates income. And then we got to realize that income is going to hit a tax return. So there's 3 tax returns that we deal with. 3 entities: personal tax return, corporate tax return, and the trust tax return. So in our world, we have to be aware of the tax rates that these 3 tax returns bring to us. Okay, again, on the personal tax return, we're dealing with 4 tax brackets: 20, 30, 40, and 50. Okay, so when we conceptualize the asset with the income, what tax return it's going to go to, those are things that are going through our head. We also have a corporate tax return. Okay, that has 2 taxes, two tax rates, 12% and 50%. Corporations create different types of income, active income, passive income. So, and then we have a family trust, which if we create a family trust while we're alive, it has a 50% tax bracket. Okay, we don't want to pay 50%. So those are the 3 entities that we deal with and the different tax brackets. So we're looking at the personal tax return, 20, 30, 40, 50. We're looking at the corporate tax return, 12 or 50, or we're looking at the trust, 50%. Okay, so then we go back to the asset and we go, okay, well, what type of income is this asset producing and where do we want the tax to be applied? Well, the lowest tax rate I just mentioned was 12%. Okay, so we certainly target that 12%. The best tax rate is 0. Okay, and there's ways to do 0. So, but conceptually, I want you to understand what I'm saying. There's the assets, they generate the income, we have to pay the taxes. So now let's focus on these assets. So when we manage money, we're dealing with the different assets that people are able to invest in. And it's not up to us, it's up to you. We strongly believe in financial education, giving you the right information so you can decide what assets you want to be invested into. And I kind of conceptualize that, break that down in simple terms, that when we have assets to invest into, we break it down into kind of 3 categories. One is either the public market, okay, which is really stock, bonds, and mutual funds. So that's one market we can go into. We can go into the real estate market. Okay, that's another market. We deal with a lot of real estate investors. So that's an area that we really focus on. So when we're managing money, we can look at the stock market, we can look at the public market, we can look at the real estate market, or we can look at the other market, whatever else is out there, which is predominantly gold. It, in our world, is gold and silver. Okay, we're also a gold and silver dealer. We do a lot of gold and silver. That is going through the roof. Anybody that follows the gold and silver market. I bought silver 2 years ago. It has almost tripled. Okay, and that's crazy. And it just seems to stand the test of time as far as, I mean, why is this keep going up? It seems like the bigger problems in the world, people run for these precious metals. So that's part of our, so when we look at asset management again, we're looking at either the public market, we're looking at real estate, or we're looking at gold and silver. So the public market, those that know me know I'm not a big fan of mutual funds. Okay. And one of the reasons is our job as money managers is to, first of all, protect your capital. Okay, the first thing we need to do is protect your capital. Second thing we need to do is make you money. Okay, so when we're in the stock market, and stocks or mutual funds, as we all know, we're bouncing up and down. Okay, we're going up, they're going down. And I've been in this industry for 40 years. I've never yet met one person that can accurately tell me what's going on in the market. So we don't have a lot of faith as far as, where are we going? Lots of people are in the market, and I'm not saying you shouldn't be in the market. I'm just saying, be aware that if you're invested in mutual funds, there's probably not a lot of capital protection. You can make a lot of money in the market. People have made a lot of money in the market. Okay, so I'm not saying don't be in the market. I'm saying understand when we're trying to protect capital, we're trying to make a rate of return. The market is very volatile. It goes up and down. So we're trying to protect capital. So, and the other thing is the bank, they will just push their mutual funds forever. I mean, it's again propaganda. As soon as we get into January, they're pushing RSPs. Okay, drives me nuts. Got to have money in your RSP. They make you think that you need RSPs to retire. You don't. You need money. It doesn't have to be in registered form. And then if you do go to the banks and put the money into their RSPs, they'll put you in mutual funds. Okay, the problem I have with mutual fund is the management fees. Okay, you're paying way too high of a management fee at the bank. So when we do manage money, and if we are staying in the market, we move all that money from the bank into what we call a robo-advisor. And the robo-advisor is simply mirroring the indexes. TSC 300, that means there's 300 shares. And that's what a robo-advisor does, just keeps that money in those 300 shares. And you're saving at least a point on the management fee. I've never said the robo-advisor is better than mutual funds. We're bouncing up and down in the market, but you're at least bouncing up and down at a lower fee. And that means a lot. So saving 1 point on management fee is a lot. So that's how we manage the money in the public markets. And so then when we look at real estate investing, so we go the public market kind of into the real estate focus, that's where we had a wide array of different types of real estate investments. So when people say, well, I'm a real estate investor, what does that mean? Okay, what are you investing in? So there's many different types of real estate investments that are available to people. Lots of people have their own rental property. Nothing wrong with that. Okay, that's you're investing in real estate. And lots of people, we do a lot of different type of real estate investing. Fix and flip. We kind of stopped. We did a lot in Toronto where we buy a house, we rebuild it and sell it. That's called the fix and flip. A little more risky because we're exposed to the market. Well, the market better be in good shape in 9 months when we're done with the house. Probably more risk than most people want to tolerate, but for those clients that do want to take risks, that's what we used to do. I say used to do because in the good old days we could buy. It sounds insane being up here in Wasaga. In Toronto, you buy a knockdown for $1 million. Literally spend $1 million to buy the place and knock it down some 600 to rebuild it and sell it for $2 million. And it was a pretty simple business model. Now that knockdown is 1.5 million. Now you're into that very sensitive $2.5 million market that we're not doing as much of it anymore. But we do that with client money. If the client is interested in those type of investments, that's what we do. Fix and flip. We do joint ventures with clients. Okay, clients, we're our most favorite type of investment is multi-unit apartment buildings. Okay, Our niche is 15 to 35 units. We'll do that with quantity. We're talking about real estate investing. For those that really want to be in real estate, but really don't want our headaches involved in real estate, we have real estate income trust. And David will talk a little bit about that. Again, being in this business for 40 years, if there's one investment type that sticks out above the rest, it's real estate income trust. Okay, why? It's because we accomplish everything we're trying to accomplish, protection of capital. Okay, the best way to protect capital is with good real estate. Okay, there's good and bad real estate. Okay, when we look at these multi-unit buildings in good locations managed by good companies, that's as good as it gets as far as protecting your capital. And these real estate income trusts are continually, I've been putting clients into real estate investment trusts for 25 years, and they've done everything we want them to do. Every single client that's invested into a real estate investment trust is happy because it's done what they've done. And here's the beauty. When I go back to the investment, the income, and the tax, these real estate income trusts distribute income as return of capital, no tax, zero, nothing. Okay, that is as good as it gets. So when we look at the asset, the income, the tax, that's as good as it gets. Okay, now why can that happen? All right, and again, real estate income trusts are very easy to understand. Just picture a rental property. You collect rent, pay the mortgage, pay the insurance, pay the property tax. What's left is yours. Okay, that's what a real estate income trust does. It amplifies it by 10, 20, 30, 40 big buildings, 100-unit buildings. The concept is the same. They're taking the money, they're buying the building, they're collecting the rent, they're paying the mortgage, and they're paying the property tax. They're taking their management to whatever left is distributed to the people who have invested in these things. And that investment goes back as what we call return of capital. And I don't want to get overcomplicated, but what happens inside of the REIT is they claim depreciation, capital cost allowance, to bring the taxable income in the REIT to zero. So when they distribute money to you, it's not taxable. That's what kind of happens behind the scenes, which is way beyond what we're talking about today. But the most important thing is, if you can understand what I'm saying, you look at the asset, it's got to generate income, it's got to hit a tax return. That asset generates return of capital income, and it's non-taxable on your tax return. That's a beautiful thing. Okay, and there's many different REITs. I'm not the specialist. David is the specialist on the REITs, but I can tell you that is a very, very popular real estate asset that we use for retirement planning. Okay, but one of the problems that happens when you retire is the tax that we pay. We have to lower our tax. I'll repeat myself. Part of retirement planning is making sure the tax system is working for you and not against you. Okay, so we can get an asset and it can generate income that we don't pay any tax on. That's a good thing. Okay, and there's other different types of asset classes in the real estate mortgage lending. Okay, again, we're looking at protecting the asset, protecting your capital, and getting your rate of return. We do a lot of mortgage lending. David does a lot of mortgage lending. Okay, we register the mortgage against the property. You're secured as long as proper loan to value. Not saying something can't go wrong. Okay, but we have to protect. We have to mitigate that risk. That's our job, to make sure that the money that's being registered is a suitable property, could be sold quickly if need be, that we're registered, their loan to value is not out of whack. So once again, the asset there would be mortgage lending, where you can lend as a gift. Okay, that's called a mortgage investment course. You can lend individually. You can lend your money as a mortgage and collect the interest. So there's two ways really of lending as mortgages. I always kind of say that when we invest in real estate, another conceptual way to think about it is picture a house. Okay, we can own that house individually. That's just owning in your own rental property. You can own that house as a group. That's a real estate income trust. We can lend against that house individually. That's just us lending mortgage. Or we can lend to that house as a group, and it's a mortgage investment corp. So those are different options that we have conceptually. How my time, David?
Well, I think we're coming to about that time, but perhaps we could pause to see if there's any questions.
Yeah.
For Gerry, we could take a few minutes and then I'll jump in. Janice, go ahead.
Sure.
basically no tax because you're drawing down the capital. What happens when you get out?
Yeah, so that's a very good question, and I'm glad you asked it, because what happens is this tax-free income has repercussions. Okay, so here's what happens. You put $100,000 into an investment. I'm just picking the number out of the air. I think the minimums, different ones are 5,000 or 10,000. It's just conceptually, you put 100,000. And the rate of return historically has always been between 7 and 11%. And that has happened every year, not up and down. Every year you're making. And I tell you, when you get consistent earnings, you get a compound effect. That is amazing. So it's better to earn consistent income than minus 10 one year, 30% net this year. So we earn consistent income, and it comes from two places. One is the distribution. Okay, you put 100 grand in, they put it into the apartment building, they collect the rent, minus the management, minus everything else. There's your distribution, and the distribution is usually 6%. Okay, so they're giving you 6% of the net rent. That is non-taxable. That is return of capital. Okay, the rest of the growth is the appreciation on all the buildings. Okay, so you put in 100,000, they pay you a 6% distribution. So if you took that as cash, at the end of the year, you look at your statement, it will show $100,000. They paid you the 6%, you put it in your pocket, your investments went $100,000. That was appreciation. These buildings go up in value. So now the appreciation would be 2 or 3%. So your statement would say 102, 103,000. That money that you've received, you can either put in your pocket or you can reinvest it back into the investment. So if you put it back into the investment at the end of the year, your statement will go 109,000, 110,000. Now, to answer your question is what happens when you sell that investment. Okay, in very simple terms, you're going to pay tax on half of the money you received for free. Okay, basically what happens is the money you receive for free reduces your adjusted cost base. So when you sell it, you can pay capital gains. So to make it as uncomplicated as they can, the money you receive for free, when you decide to sell, you're going to pay tax on half of the money. So half of the money is completely tax-free forever and ever and ever and ever. The other half, you're going to pay tax when you sell. And the thing that we like about that is financial planners, retirement planners, estate planners, is we get to pick that time. So we're going to pick a time when maybe it makes sense on your tax return to sell that product and deal with the tax implications. And again, half of that money is completely tax-free. So any other questions? I know
We'll have time for more questions as well. Was there one more question?
I just wanted to ask about the rental income or rental property. What capital gains?
Sorry, when does
Capital gains take effect? Like somebody's talking to 3 years.
well, capital gains is going to the impact of capital gains will happen when you sell.
Yeah, yeah.
Okay, so that's again from a planning point of view, that's helpful because we're going to go, okay, when do we trigger the tax? When do we sell that property? And again, on rental income, again, we deal with a lot of real estate investors. So when you say rental income, again, we can probably all easily, figure out, we have a rental property, gross rent minus expenses equals net rent income. Okay, once again, that's the asset, that's the income. Where do we want that on the tax return? Okay, net rent income on your personal tax return depends on your tax bracket, 20, 30, 40, or 50. So if you have a job making $100,000, the last thing we want to do is put more income on top of that 100,000 because we're up into the 40 and 50% tax bracket. A lot of times we'll channel that net rent income into a corporation at that 12% tax rate. That's a nice low tax rate. So that's all tax planning, that's all retirement planning. Yes.
But does the property have to be in corporations?
No. So she's asking me, does the property have to be in the corp? You can own the property personally and you have net rent income and you have a lot of money on your personal tax return already. We don't want to put that net rent income on. We create a real estate management corporation. So your corporation is going to manage the property that you own. And we're going to move that net rent income away from your tax return, personal tax return, and move it into the corporate tax return as active income and pay 12%. Okay. So that's just getting the tax system to work for you. Because once again, I go back to if there's no integration between your tax life and your investment life, probably guarantee that you're paying too much tax. Another question, or you want to go?
Yeah, let's come back to.
Okay, yeah, sure, there you go.
Okay, all right, good. Oh, thanks very much, Gerry. Thanks, Gerry. Yeah, always a wealth of information. So the purpose today is not to tell you everything you ever wanted to know, but it was to whet your appetite. You've got Gerry's contact information. He'll be around for a while, so you can have some questions and have one-on-one conversation with him later on, of course. So as I mentioned before, I'm a mortgage broker and a dealing representative. I also a musician, but that's a topic for another presentation or music event, as it were. So as a mortgage broker, I've been arranging mortgages for about 22 years, and I do all types of mortgages, from first-time home buyers to move-up buyers to self-employed. And I wanted to speak a little bit, and construction mortgages, that comes up too. And I wanted to speak more from today from a perspective of from a retiree, because there are a lot of retirees here in Wasaga Beach, especially, and whether you yourselves need to borrow money, or maybe you know somebody who needs to borrow money. Retired people have a common challenge when it comes to qualifying for a mortgage. Anyone know what that might be? Income. Good answer, Tal. Right, reduced income, but maybe you have the equity in your home. So there's a variety of different solutions, mortgage solutions for people who are on a reduced income. It's not for everybody. It requires long-term planning, careful consideration about your goals and what's right and not right for you. So there's no one answer for any. It varies depending on the situation. You heard no doubt about the reverse mortgage. I'll just talk a little bit about what that is and how it helps some people. The reverse mortgage, very simply, is a mortgage where you don't have to make payments. Simple. You can also get a mortgage that basically pays you. So if you need to supplement your income and you have equity in your home, you have to be usually 55 years of age to qualify, at least. And the older you are, the more money you can borrow. It's a pretty simple formula, right? The value of your property and your age. And there's a product now for people who are under the age of 55. If they're going through a period in their life where they're, have a reduced income or no income, and they have the equity and they need a break from making mortgage payments. That's also possible. But as I was alluding to, there's also a mortgage product where you can have your house pay you. So you don't have to borrow like a lot of money all at once if you don't need it. You can take a small advance. Maybe you need $25,000 or $50,000 to deal with some debts or for one reason or another. And then you can have your house pay you $1,000 or $1,500 a month. If that's what you need. There's a lot of different reasons people consider the reverse mortgage. Sometimes people are in trouble and they have debts and they want to stay in their house. If they have the equity, it might make sense for them. Also, some people want to take out equity. They may need to do certain work or repairs to their house. Maybe they want to help an adult child to purchase the property. Great reason to convince your kids to come on up to Wasaga Beach. Hey, there's a house down the street for sale. I'll help you with the down payment, right? I have a one pager. This is a 8.5 by 11 business card today. I'm going to pass these around. If you'll take one and please pass the rest. I'll keep one just so I remember what I'm talking about. So one side is like a business card. It talks about just the different types of mortgages. But this other side, I'd like to draw your attention to it for a moment because it's interesting. It's interesting. It's this side here, and it says reverse mortgage scenario your equity after 10 years. And what this simple chart illustrates is that if you have a home value of $1 million today, and you assume that that home appreciates at 3% per year, which is not crazy by any stretch. If you look at real estate values over the last 20 or 25 years, they'll ask any real estate agent. I believe they'll tell you that its real estate has gone up by about 5 or 6% per year. So we're making a much more conservative assumption here, 3% appreciation of the real estate. And we're assuming a reverse mortgage of 350,000. That's a lot of money, right? I mean, if you have no mortgage today and you borrow 350,000, that's a lot of money. So obviously you don't have to, but maybe you've got a mortgage of 300 today and you're having trouble making ends meet, making the payments. You could take out a 350 reverse mortgage. It pays out the existing mortgage, gives you some cash in hand that you may need for different things. And you don't have to make payments. So if we assume a mortgage rate of 6, so what happens to the mortgage is it simply accrues, right? And this is where some people say, oh my gosh, it's the bank's going to take my house, all my equity is going to erode, there's going to be nothing left. So this chart shows what would happen to your equity. And you can see that even with the interest accruing, $342,000. Hi, Letitia. Welcome. There's Letitia. I alluded to, and I'll introduce you guys again shortly. You can see that even with $342,000 in interest over 10 years, no mortgage payments, the mortgage interest accrues, that you actually have about the same amount of equity in your house. Again, you're considering a 3% increase on $1 million value per year. And you're considering a mortgage that you're not making any payments on. And there's no effect on your equity. Okay, so this is just one example. Okay, I'm not gonna sit here and tell you that your equity will never be impacted if you take a reverse mortgage. That's not the point. The point of it is this, and I do see this, I'll tell you, sometimes people need to take care of themselves. And if the equity is there and it's important to you to stay in your home and it makes sense for you, if people want to leave an inheritance, that's very nice, great to help your kids. Like I said, you can give your kid an early gift if you want to. You can travel, you can do different things. Your home equity is there. Think about it like a possible tool to help you in your retirement age. People need to take care of themselves as well. Okay, so long-term planning is important. All right. So that's the story with the reverse mortgages. Now, I want to talk a little bit about mortgage lending. I mentioned to you before, I'm a licensed dealing representative. So I sell some of the products that Gerry was talking about, the REITs, real estate investment trust, which the ones that Gerry and I promote usually are cash flowing apartment building. They're not high risk development projects. But mortgages are near and dear to my heart because I understand mortgages. I understand about private lending. And that's something that over the years, people have said to me, David, I would like to invest in mortgages. Can you help me out? And I like to help people who want to invest in mortgages where I can, but the reality is I just don't see enough good mortgage deals to invest in to share them with all of my friends and business associates and potential investment clients. So I got licensed as a dealing representative because we have access to some mix of mortgage investment corporation that I deal with on the mortgage side. So I've known them for years and I have some of my own money invested with them. They're returning 9%, 10% per year. It's interest income. So it's from a tax perspective, it's not as favorable as a REIT, Okay, because interest income you pay the most tax on. But if you have money in a TFSA, for example, or an RSP, if it's an RSP, you're tax deferred. If it's a TFSA, you're allowed to up to around $100,000 per person. If you're not maxing out on your TFSAs, or maybe you have some things in your products in your TFSA that you would want to switch out and invest in mortgages or REITs. So the basic idea with a mortgage is if, depending on what you're investing in, generally speaking, it's lower risk than owning real estate. So I'll give you a simple example. If you buy a property, and it's a bit extreme, but it's a simple point. If you buy a property and you for $1 million with 25% down, 250,000 down, and then the market dips by 25%. Hopefully that wouldn't be the case. How much money have you lost? You've lost all your money. You've lost your 2,200. I mean, you don't realize it unless you go to sell the property. So it's different if you're living in it, it's a long-term thing. But if it's an investment property that you bought for $1 million with 25% down and the value drops by 25%, you've effectively lost all your money if you had to sell it. Okay. If let's say you're the mortgage lender in that scenario, and you've loaned 75% of the value, you haven't lost any of your money. If you had to force the sale of the property, let's say it went into power sale or something like that. I mean, there's selling costs and that kind of thing. But basically, your money's still there. If the property sells for 750, you've loaned 750, and your money's still there. Okay. So that's the difference between owning real estate and investing in mortgages. So the types of mortgages that I like to lend on, and the types of mortgages that these mortgage investment corporations are investing in, are usually single family homes, or maybe duplex or triplex, but nothing wild. Okay. And they look carefully at where the property is located. What's the loan to value? If you're going to invest in a mortgage, you want to make sure that it is a property that is marketable, that if you had to force the sale for any reason, for non-payment, or default, right? If you had to do that, you're the types of properties. And like, I'll give you an example. There's a company called Ginkgo Mick, and I have some of my money invested with them because I've done business with them as a mortgage broker, but I also see the files that they decline. And I say, why did you decline this file? Well, is it a small town, population less than 10,000 people, too far away from, and I say, oh, okay, it's interesting. So I learn from them, and I see how they lend, and I see how they don't lend. And I say, sometimes as a mortgage broker, I'm frustrated. I just wanted a loan approval to offer the borrower. But then I think that's the kind of mortgage investment corporation I'd like to invest in. They don't just approve any files. So that comes into consideration. Are there any questions about? Yes, go ahead, Susan.
These mortgages for high risk people.
Yeah, right. Good question. Are they for high risk people? Yeah, very good question. So you could say that. You could say that because if these people were qualified at the bank, they wouldn't be looking for private mortgage, right? So there's a few different types of lenders out there. You've got your A lenders, your prime lenders, those are banks, and like big places that are like banks, credit unions, trust companies. Then you have what they call B lenders. So these are institutions that lend, they charge a little bit higher rate than a bank, they're more flexible. Then you have C lenders. C lenders are private lenders. You could be a private lender, I'm a private lender, okay? And why would we lend on that type of a mortgage? Who is the borrower, and what are their circumstances that we would consider lending them money? So usually it's a transitional thing. Let's say, for example, in a real estate transaction, somebody has gone and bought another property, but they haven't sold their place yet. Okay, so they thought they were going to be able to sell their house, no problem, get the equity out and use it as a down payment on the purchase. But market conditions maybe have changed. Maybe they miscalculated and thought it would be easier to sell their house than it actually is. So now they have to close on the purchase, and the bank's looking at it and saying, you don't qualify for the mortgage you have on your current house, and you don't have the down payment, and it's too much debt overall. We're not going to lend you the money. So what we could do, we could arrange, if it makes sense, we could take equity or do what's called a blanket mortgage. So we could take some equity out of the property that they own, use it as a down payment on the purchase, and then do a blanket mortgage on the two properties. So that means you're secured by more than one property. Okay, yes.
So how much is it along our side? If it has to be, if they're not making a payment, like you said, we get our money back anyway. Well, usually the tenant side that gets losses. So,
Case not.
no, it's not a tenant thing, but we're,
Right, so if the owner doesn't pay, if the owner doesn't pay us, well, that's a risk. And that's one of the reasons why it's a good idea to consider investing in a mortgage investment corporation, because they have professional management that will take care of that. But I was in a situation once where I had loaned somebody, I did a private loan, and I had to get the lawyer to issue a statement of claim. And it costs some money, but you recoup all that. So you just need to know that there's enough equity in a property. So I usually wouldn't go beyond 65 or 75% loan to value, maybe. Now, loan to value is a key metric. I used the example before, $1 million house, $750,000 loan. Doesn't mean you have to have, by the way, $750,000 to invest in private mortgages. But let's say there's a borrower who owns a property worth $1 million, has a $500,000 first mortgage with a bank, and needs $50,000 or $100,000 additional money. And the bank's saying, you know what, you got laid off, you don't have the income currently, or you recently retired, or you're self-employed and the last year has been slow, we're not lending you the money. So you look at this and you say, okay, here's a person, you look at so this is what I do as a mortgage broker. They call it underwriting, but basically you look at the full scenario. Okay, what's the past earning of this person? Is this person, have they been working? What's the story with their credit? It's not terrible if their credit has been bruised. And if their credit has been destroyed, well, what's the story? What happened? Maybe it was sickness, and they could have sold their house, but then again, maybe there's a lot of equity, and maybe they're now better. They're recovering from something, and they've just started a job, but they're not permanent and past probation yet, or their job prospects are good because they've been doing something that's a good skill and they've been doing it for a long time. So you want to look at the story, the borrower themselves, what's the credit, what's their income potential, and you also need to have an exit strategy. That's key, right? Because if you loan the money, you want to know that you're going to be able to get paid back and get out. And like I said before, you can earn 9-10%, you can earn less than that, and you can earn more than that. There's some mortgage lenders that are earning 15-18%. But the higher the percentage, the higher the risk. Okay. So for me, I'm usually in the 9 to 10% range. I would lend my money to borrowers that I know have the potential, they've had past potential, and that if things don't work out for them, they will take steps. They're responsible people. They're going to take steps to sell the house if they have to, right? So you want to know who you're lending your money to, what's the story, what's the reason for the loan, and how you're going to exit this loan. Does that answer your question, Susan? Yeah, okay. Other questions?
So David,
Yes,
you're,
Cal.
you are asking a lot of their history then, sometimes even health history or like to
Yeah,
prove it, they
well,
say, well, I was off work for 2 years because of an illness. And you like can, okay, if you want to go further, show me. Is that true or
Well,
how deep are
I
you
mean, I
going?
wouldn't ask for their medical records, but I would, I would want to know what's the story like. Okay, so you've been off for 2 years, and look, there's no such thing as a sure thing. But I'm not lending them 95% loan to value, right? We're talking much lower numbers. So the point was for that borrower who needed an extra 50 or 100,000, there's an opportunity for a second mortgage investment there for somebody. Keith, did you have a question? It looked like you had one. Okay.
So David,
Yes.
to clarify, you could, if you're a savvy investor yourself, you know the real estate market and you know it's a good deal yourself, it may not even matter about the borrower. That's just a bonus, right? If you know it's a good deal, even at 75, you know the market,
Well,
then you're pretty safe.
well, I wouldn't lend without knowing who the borrower is.
Of
I mean,
course, but
the borrower, like, you can choose to what's the right word? I don't want to say overlook, but you need to know who the borrower. You need to know who the borrower is,
Yeah.
why they're borrowing the money, and what's the plan for you to get paid back. Sometimes if their income is totally down, you can do prepaid interest, so they don't have to make any payments for 6 months or a year. But private lending is usually transitional. It's usually short term. Somebody needs the money. It's some kind of a bridge because it's very difficult for somebody to, be paying 10% interest rate on a mortgage for a long period of time, right? So there needs to be an exit. They're going to sell a property. Um, there needs to be a plan so that you're going to get your money out. Yeah. Yes.
Minimum investment for these.
Well, so the minimum investment with the mortgage investment corporations is, I think it's $10,000. Yeah, yeah. $10,000. You can get your feet wet, start earning some interest, and go from there. So it's a compliment. Gerry and I, we would never recommend that somebody put all of their money into private investments. Private investment is a mortgage investment corporation or a REIT, as an example. And these investments, they're not on the stock exchange. Gerry, I'll ask Gerry to maybe talk a little bit about his background in the investment world and how he was talking about volatility, okay, and that's that's a killer. So Gerry, do you want to talk about how it is that you got into private investments? So they're not on the stock exchange, so they're not going to, you can have a good underlying product, but when it's on the public market, the value of it of your shares can swing wildly just based on public mood, whether it's a good underlying investment or not.
All right, thank you. Mhm. So my background, to kind of follow up what David had said, was so make the long story short, when I worked at the Latouche chartered accountants for 10 years in your tax department, after which I set up my own practice and got into the investment world. That's what took me through all these different, the public market, and I was really looking for real estate. I started my real estate investment journey and I was looking for opportunities. In the public market, we don't find real estate opportunities. So that led me to what we call the real estate market, which is otherwise known as the private market. Okay, and that's where we stumbled into these REITs and found out all about them. I was a dealing rep for 5 years with Pinnacle Wealth, which is the largest private equity broker in Canada. So we did a lot of business and we really worked inside that business and learned how the whole business worked. So the big difference, the public market they have a stock market where you buy and sell. So it's a very liquid market. Okay, so if you have a mutual fund, if you have a stock, if you have anything on the public market, you can get rid of it immediately. There's a secondary market for it. Okay, the only time you can't is if they shut down the stock market, which they've done actually. But in essence, very liquid, you go in, you go out very quickly. That's the public market, publicly traded stocks. Private market is not very liquid. Okay, so even though we go on about all the benefits, the tax benefits, the investment benefits of something like a REIT, where the liquidity is challenged. So when we say, "Oh, I'd like to get my money back," oh, okay, well, we have the next redemption is March 31st or June 30th, usually every quarter, so that's redemption dates. So we're not as liquid, and those things have to be taken into account when you make decisions to invest into those type of markets. Okay, liquidity is very important. Very liquid in the public market, restrictions in the private market. So we always say when we talk about people in mix or REITs, you have to be a bit of a longer term investor. We don't want people putting money into a REIT to try to make money for 2 months or 3 months and then get out. We wouldn't let them do that. So it's more longer term investing. But they're private equity companies. REIT is a private equity company. MIC is a private equity company. One of the reasons why I do like them a lot is because there's no correlation to the stock market. Okay, when the stock market goes up and down for whatever reason, we don't care in the private equity world because we're not correlated to it. And that's really important when we're dealing with volatility. Okay, we don't like volatility. So, and even REITs, as far as I'm concerned, there's no correlation to the stock market. And in my opinion, there's no correlation to the housing market. Okay, we've seen some pretty interesting things happen in the housing market, gone up a lot, down a bit. There's no correlation because we look at a REIT from a business point of view. Okay, what is the revenue that's driving this business model? It's rent income. Okay, rental income is strong. We know it. People can't afford houses. There's still, you can talk about immigration, but they're still bringing people in. And they will continue to bring people in. Maybe not 500,000 people a year, but 200, 300,000. So the need for rental properties will always be strong. Okay, and that's the revenue driver to a REIT. So we're not worried about the stock market. We're not worried about the housing market. But when we do consider these type of investments, we do have to consider liquidity. Okay, are they as liquid as we want them to be? And in fact, a REIT, they can actually say, okay, we're shutting down redemptions. Okay, and they don't usually do that, but those are things that people need to be aware of. And they might shut down redemptions because we're going to save all our money and we're going to take all our net rent income and we're going to buy that building over there. So in essence, they're trapping your money, but it will work out because they're going to buy another building, which would mean your appreciation will grow. So I don't want to scare people because that really none of the REITs we deal with do that, but technically they can. Okay, and the other difference between these public investments and private, the public investments on the publicly traded stock market, when you invest, you have to provide you a prospectus, okay, which is just information about the investment. And thank God we have online now, because used to be you get these things physically. There's 600 pages, and I've never met any person that reads it. But that's just there. You have all the information you need. There's 600 pages, so don't say you don't know what you're investing in, which is ridiculous. But that's anything in the investment on the public market, mutual fund stocks, you're getting a prospectus. In the private world, we don't need to use prospectuses. We can use what we call offering memorandums, which is a condensed version of these prospectuses. So they're a little more reading. They're 100 pages. And if you're an accredited investor, which means you have $1 million of assets, liquid assets, you get what we call a term sheet. So there's different things that happen in that private equity world. So again, I'm not going to have every question answered here today, but just understand it's a different world, a better world in my opinion, just simply from a volatility point of view. But as David mentioned, even private mortgage lending, you have to know the lender. As you asked about the health, that was interesting. It's a pretty good point. I'm not paying because I'm sick. Okay, well, what's the matter with you? But most of these private mortgages, I know the ones that we do, we put clauses into that mortgage. You know, and I think you asked the question, do we just lend to anybody as long as the asset is good? You know, the asset is our protection. So if the asset is good, sure, we have to know about the lender. But we put clauses in those mortgage, hey, you don't pay, you know, an NSF check is not $150, it's $2,000. Well, that's a lot of money. Well, make sure you don't bounce a check. You know, your property taxes are in arrears for 6 months. So there's a $5,000 fee that we put on the mortgage doc. Well, that's expensive. Well, make sure your property taxes are paid. So there's things you can put into the mortgage document that protect the, like, yes, you got a question.
I just want to go back to what you said about how, these are not affected by the housing market. I'm trying to get my head around that because when you're dealing with loan to value and portion of rental income
Yeah.
to the cost, to the cost of the house or the property, rents are going down nonetheless. And
So
so,
you're right there. Rents are going down from ridiculous size.
Yeah.
Okay, so they're coming back down.
and sort of prices, then the housing prices are
Well,
ridiculously high and they're slowly.
I don't know if I should say this, but when we're in the REIT world, the rental world, we don't care about how the prices of houses. Because people will pay a premium for the house they live in. Oh, I love that house. I'm gonna buy it at that price. In the real estate investment world, we deal with cap rate.
Right.
Cap rate is simply the gross rent minus all the expenses except the mortgage. Whatever that number is divided by cap rate, you say it would be a 5% cap rate. There's your value.
Okay.
And that's what people will pay, and that's above that, people will not pay, because we're looking at it from an investment point of view. Sorry to cut you off.
Actually,
Yeah, so we're not worried. Shouldn't say we're not worried. We take it into account, but it doesn't affect our business maintenance.
okay.
We're dealing with cap rate. Cap rate is driven by rent. Rent is not going to be affected. As you say, it's gone down. I experienced it. I mean, my rent's doubled. All of a sudden, my tenant leaves, and geez, I get it's twice as much rent here. That's ridiculous. So they've come down to reasonable levels. Okay, and they will always be, because here's another way to look at it. You've got this is the way I look at it. You got the housing market. You got the high end, you got the medium end, and you got the low end. Okay, well, the high end is going to have the biggest impact. And when there's adjustments in the housing market, those houses are going to get hit. The medium, if there's a market correction, the top will push down, the mid market will try to push down, but the bottom market is protected by cap rate. It's not going to go lower than the value of that house if you rented it out. It's not. So it's the foundation. It might go down a bit, but it's not going to go down to ridiculous lows, because people will just say, "I'm just going to rent it then," because the rents will still be strong. The housing market really doesn't correlate to the rental market. Okay, the housing market has gone down, but the rental market hasn't gone down as much. The rents are still ridiculous. And should I segue, Letitia? Because one of the things that when we talk about different real estate investments and what we're investing in, REITs, mortgage, you know, we also, part of those real estate investments are investing outside of Canada. And I tell you, I've spent more time in the last 2 years talking with clients who invest outside of Canada. Okay, the real estate opportunities in Canada are becoming restricted and limited. They're not out there as much as they used to be. There's still deals there. There's still opportunities, but it's not like it used to be. It used to be anything you invested in went up in value. That's not the case. So we have to be a little more careful in Canada. There's still opportunities, but we look outside of Canada. Lots of my clients are investing in the US, lots of them. Okay, the whole US real estate rental market is way better and easier than it is in Canada. And then there's people that look outside of Canada and US. Okay, we have a lot of clients that invest down south in the Caribbean, not only for personal reasons, but for investment reasons. Okay, Airbnb is a beautiful thing. Buy a property, you Airbnb it out, you want to use it for yourself, you block off the calendar and you go down and use the property yourself. So it's a beautiful thing, probably a segue into our friend Letitia, and I'll let you bring her on. Any other questions for me? Or
Thanks very much, Gerry. Again, Gerry and I are both available for consultation. If I had everybody's phone number here, I would call you all. but we didn't put that on the form. But you know where to reach us. You've got my phone number on the sheet. I have business cards if you want. Gary's contact information, of course, is on his materials too. And we look forward to speaking with you further about any of the topics that we've talked about today. Gerry and I have been doing these seminars for years. And back when we were in Toronto, before I moved to Wasaga Beach, we were actually doing them weekly. It was a networking and education. We're doing them once a week in Toronto. And Letitia Montana, who was a regular guest, and she was also an insurance agent at the time. And we know that during COVID changed many people's lives, and it presented opportunities for people. It presented an opportunity for us to move up here to Wasaga Beach because I didn't have to be tethered in Toronto to run my business. And what a great opportunity to come and live out my retirement dreams here in a nice, relaxing town. And Letitia moved to Mexico, to Playa del Carmen. And she's been working with different developers. She's been working with Menace Condos. They are one of the most reputable condo developers in the Playa del Carmen area. And she's here with Marcelo Sagarina. He's a sales manager from their company. We'll plug you guys in here. There's an HDMI cord, so that way people will be able to see some photos of the developments. And she's going to, they're going to talk to us about what they do in some of the developments. So hang on a little bit longer. There is more coffee if you want, and then we'll let you go. So yeah, thanks again everybody for coming out. And I give you Letitia and Marcello. Welcome, guys. Thanks for coming up.
And thank you.
Okay.
You want to record?
Hi, everybody.
Hello.
Does this work?
Yeah.
How many of you have been to Mexico before? Hands up. Quite a few of you. How many of you have been to Cancun, Playa del Carmen? Okay. As Gary mentioned, I'm a fellow Canadian of Romanian descent, in case you're wondering about my accent. I used to live in the Toronto area for 24 years.
Bună ziua!
Bună ziua, domnule!
Democrats.
We will continue Romanian after the meeting. When David moved to Wasaga, I moved to Mexico. I have a Mexican connection. My son is half Mexican. He's 10 years old. So that was an easy excuse. One of the reasons I also moved to Mexico was because at the time, it was one of the freest places in the world. I wasn't keen on what was happening in Toronto at the time. I grew up in a communist country, quite frankly. I don't know if you are from Romania as well. No, okay. Well, I was searching for more freedom, and I also had gotten quite tired of the brutal Canadian winters after 24 years here. I don't know if I have, I don't know if I want to live another winter with this SAD, as it's called. Yeah, it was getting to me. I was getting depressed in the winter, so it was a good excuse. And as soon as I moved there, I started helping fellow Canadians and Americans with initially rentals, and afterwards some of my, as David said, I used to work as an insurance broker in Canada. One of my insurance clients became one of my first clients to buy a condo there, and it just went on from there. And I work as an independent broker. I have an assistant. I started a firm called Freedom Playa Real Estate for obvious reasons, wink, wink. And one of the companies that I have had the pleasure to work with is represented here today by my colleague Marcelo. He's one of the sales managers. Menace Condos is the name of this company. They happen to be one of the largest developers in the area. They have built 19 boutique luxury condo buildings in Playa del Carmen, between Playa del Carmen and Tulum. Before I introduce more about Menace Condos, I want to tell you personally why Playa del Carmen. Why did I not move somewhere else in Mexico? Why did I not move to the US, for example? I had similar concerns about the politics in the US, and even more concerns. I'm sorry to say, I know Gerry, mentioned investments in the US. That's obviously a factor or potential opportunity. I was a little concerned about the gun situation. And I had previously to moving to Mexico, I had visited as a tourist Playa del Carmen in particular. And it's an area where you can walk to the beach in 10 minutes. You can walk to the grocery store. You don't need a car. English is widely spoken. I happen to have learned Spanish, so I do speak pretty fluent Spanish. But even if somebody doesn't speak anything but hola, you could find yourself there. You can walk to the beach. You can walk to the grocery store. We have an infinity of coffee places and restaurants. It's a very easy lifestyle. It's a very soft landing spot. Furthermore, it's a 3.5 hour direct flight from Toronto. Uh, we have a variety of airlines, and Cancun Airport is one of the most, it's one of the busiest airports in Latin America. So it's extremely well connected. So I knew that if I wanted to visit my parents in the GTA, they live in the Thornhill area where Gerry and I used to have our event, and David, we used to have our events. And that was gonna be very easy. So I'm staying at my parents' house right now as I'm visiting, so it was a good opportunity. So that was one of the reasons I wanted to live in a walkable location. I thought about Merida, I thought about Cancun, which are other popular expat destinations. You will need a car if you live in one of those other cities. If you come to Playa del Carmen, either for a short stay or potentially decide to acquire a property, you will find that it's very easy to get around. You don't need a car. You can rent one if you want, but I don't think many of us want to necessarily deal with that when you're on vacation, or vacation, or even again, what we have right now in Mexico are many Canadians that are choosing to spend their winters there. Snowbirds, I often help people. I help people with both rentals and purchases. And we have rental clients, Canadian snowbirds, that like to come and stay for 6 months out of the year. As a Canadian, you get it's almost guaranteed you get a 6 month visa upon arrival, no questions asked, especially, you know, if you're a mature Canadian, they love us. They love Canadians, okay? And there are many things I could tell you about. We only have 10 minutes, so I wanted to be respectful of the fact that David is giving us this opportunity. So I'll let Marcelo tell us a little bit about this particular company. A number of my Canadian clients have bought properties with them because they deliver, and they deliver a beautiful level of quality. Please, Marcelo, go ahead. Thanks, everybody.
Thank you, Leticia.
My pleasure.
So, hello, everyone. Hola, like we say in Mexican. Good morning, buenos dias. So, I'm Marcelo Sagarena. Thank you for the time. Thank you for the space. And why Leticia is promoting us? Because she's an external broker. She can promote around 750 different developments that you can find between Cancun, Playa del Carmen, and Tulum. But why she's promoting Menezes, why she has sold Menezes, and it's because of this. This, what you see on the screen right now, are the different projects that we have delivered in Playa del Carmen and Tulum. We have delivered upon this moment 19 projects in total. We started in 2012, and now in 2025, we have 19 projects delivered. We have 28 developed. That means that we have 9 in construction at the same moment right now in Playa del Carmen and Tulum. What you can find over there, it's an immediate delivery or a pre-sale, a pre-construction. It depends when you want to get your delivery and how you want to pay it, right? An immediate delivery, of course, it's 100% paid for you to move in, and you can use different strategies like what we heard today, or you can apply for a different one, which is pre-construction paying without any interest with us. But of course, you can leave a huge amount at the end, so you can do it with a HELOC or different strategies, right? Mortgages, right?
Yeah,
You want to say something?
yes, if I may. One of the most popular ways for Canadians and Americans to acquire property in Mexico has been through the use of a HELOC, home equity line of credit. Many Canadians, we all know, so much of Canadians' wealth is in their properties. And there comes a point in time where, okay, you're sitting on the property. A reverse mortgage is a beautiful strategy for a Canadian that wants to have a better retirement lifestyle. And one of the things you can also do that David can help you with is potentially access some of the equity in your home to potentially acquire yourself a second home, retirement or vacation property in a destination like Playa del Carmen, for example, or the Riviera Maya. The Riviera Maya is the whole area just south of Cancun, this Caribbean coast of the Yucatan Peninsula that has become extremely popular in the last 20 years as an international travel destination. So the beauty with the HELOC is that you have flexibility with the payments. David can tell you all about that. we do have third-party mortgages available for Canadians and Americans to buy properties in Mexico. Interest rates in Mexico tend to be high, even for the Mexicans. They start at about 8%. And I know, it's shocking, right?
We're used to
There,
that.
so I would say, I know, even for Mexican citizens, they start at about 8%. So if you as a Canadian have the opportunity to access capital at a lower interest rate, of course, do that, especially with a HELOC, you have some flexibility with the payments. David can tell you all about that. But yeah, one of my first Canadian client who acquired property there, she did it by having a HELOC. She had some savings, but then the other portion came from a HELOC. And she's been very happy with her investments. thankfully. Oh my God, one of them.
Yeah. Yeah, well, in my experience, I have invested in 3 different properties over there in Playa del Carmen. So I can help you out with the process with Leticia and of course with the other HELOC processes, right? Now, why Menese? And it's because of this. We have a 360-degree infrastructure. We own the land where we build. That's something important that you must know. The land is under our name before we launched the project, okay? We design, we build with our own resources, the whole building, and we commercialize this one. I'm the sales manager of the company, and after we are finished with the delivery, we will give the keys to you, and we will apply any guarantee that has to be applied, of course, for the next 5 years over there in Riviera Maya. Okay? Any questions so far? No? Good?
I have one.
Yeah.
How old is your oldest project?
It's 14 years right now. Right over here, we have this is our background. We started in 2012, we delivered in 2014, 11 years right now. And it's just around the corner of our main offices. Even if you need to travel to know the area, we have the fly and buy package.
Of course, I wanted to share about that. For those of you who have not had the opportunity to visit Playa del Carmen and are interested in visiting the Menace offices, between my company and theirs, we are offering $1,500 US as a fly and buy promotion. How does that work? If you come there and you end up making a purchase in one of their developments, we would return that back to you upon the conclusion, upon signing the purchase agreement. Okay. So make it a little easier for you to.
Yes,
make
please.
it.
Can you describe the ownership structure?
Okay.
We I don't think we can in person.
Yeah, I think the best one to answer that is Leticia.
Thank you, Gerry, for that question. That's something that often comes up. There is a common myth that foreigners cannot own in Mexico. And I do want to help dispel that myth for you. And where that comes from is that there is in the Mexican Constitution of 1917, after Mexico lost certain states to the US, Texas, Arizona, they made it in their constitution that foreigners could not own land or property within 100 kilometers of their land borders or within 50 kilometers of their coastal areas. Some 60 years of Mexican government later, they realized that this provision of their constitution was really stifling foreign investment in the country because obviously the coastal areas of any country are the most desirable. Look what happened to Florida. A lot of wealthy Russians buying Florida, a lot of international buyers. Same thing was happening in Mexico, but because of this provision of the constitution, there were a lot of gray areas of the law happening. They were buying property using a portanombres, like a Mexican name. So they're like in 1973, the Mexican government said, we need to end this madness. We need to make it legal for foreigners to own property in these desirable areas. At the same time, we can't go against the constitution. So what did they came up with? What they come up with is a pass-through structure. It's a bank trust. So they allow the Mexican banks, which by the way, I know as much as the media loves to talk negatively about Mexico, I'm a Canadian living in Mexico for the last 5 years. I have Mexican banking. They have the similar laws that have to do with banking protection, just like in Canada, we have the Canada, they have the Mexican equivalent of that. So bank deposits are protected. If a bank were to go under, everything gets transferred to an equivalent bank. We literally have the same level of protection. So with that said, Mexican banks are allowed to act as a fiduciary wholly. That's the only thing they're allowed to do. The foreign buyer becomes a beneficiary owner of this trust. It is a complete pass-through structure. You as the foreign buyer, and this only applies in the coastal areas. If you're buying property in Mexico City or somewhere else in Mexico, you can do it on your own name. You do have to register as a foreign owner, but you can do it on your own name. If you do want to buy in these desirable coastal areas, and again, just as a way to skirt this provision of the Mexican Constitution, they came up with this pass-through structure. you own through a trust that is good for 50 years, renewable in perpetuity. You can, it passes, when you pass away, it passes directly, you name your beneficiary, it could go directly to your children, your husband, your wife, your loved ones, okay? You can rent your property, you can sell your property at the time of the sale. If you choose to become a Mexican resident and get what's called a Mexican tax ID, you qualify for a capital gains exemption. They do have capital gains tax in Mexico as well, sadly. It's very similar to Canada and the US. It's very similar. Again, the trust ownership is the most desirable ownership structure for foreign buyers. You could choose to set up a Mexican corporation. I'm gonna tell you, you're just gonna make your life more difficult in doing so. The Mexican corporate tax rate is a flat 30%, not the most desirable scenario. So with the trust ownership, if you later decide to sell your property to another foreigner, the only thing that happens is the beneficiary on the trust gets changed to the other foreigner. The cost to set up the trust is about $2,200, and then to keep it in force, it's about $500 US per year. These are US dollars. Playa del Carmen, this whole area is a dollarized market because it's an international market. We have European buyers, we have a lot of Americans, a lot of Canadians from all over the country, Edmonton, Calgary, Vancouver, Quebec. A lot of Quebecers. I found it very funny that somehow Quebec, Canada discovered this area before English-speaking Canada did. So if you come to Playa del Carmen in the wintertime, you're gonna hear a lot of French. You're gonna be surprised. They love to have fun. They're gonna invite you to their barbecues on the rooftop. Quebecers, they're ridiculous. Okay, they're as I like to say. So does that answer your question, Gerry? And one lovely thing about property ownership in Mexico, property taxes, my friends, are dirt cheap. To give you an idea, for a $200,000 condo, your property tax is gonna be $250 per year. If you pay it in the first 20 days of the year, 20% off, 25 up to 25% off. I don't know if that's because a lot of Mexicans don't pay taxes and they have to be incentivized. I don't know, but that's one of the beautiful things. So the trust ownership, if in the future you decide to become a Mexican citizen, you can dissolve the trust and own the property in your own name. Some people choose to do so. It is a multi-year process because you have to first apply for residency. It's not necessary. It's an option if you want to go for it. If you want to give yourself options instead, if COVID happens, like, never mind. Even getting Mexican residency is an option. Becoming a Mexican resident is helpful if you want to spend more than 6 months at a time in Mexico. That being said, a lot of Canadians, they don't want to lose their Ontario health insurance, for example. So that's the reason they do the 50-50 thing. In my case, I'm fully integrated. I'm a Mexican permanent resident, so I come now as a visitor to Canada to visit my parents. And okay, sorry, I went above and beyond with the question.
We had a question. Do you have some photos you wanted to roll because it's tender?
Yes. Thank you. Please go ahead. Will I be available if you have more? Yeah.
I've been to Playa del Carmen. I'm just vacationing many years ago. Top spot I've ever been to. Really mean that. Like, I've been to a lot of places. Playa del Carmen, nothing. Awesome now. It's a really, I'm not saying it to support her. I'm saying it because we've been there. It's beautiful. So it really is.
Because it's too low.
Tulum is beautiful. And we have an airport over there.
Yeah, and it's growing very, very good.
Definitely. No, we would love to have you guys. Remember the flying by promotion? Marcelo and I both brought flyers. I have my contact info. I work as an insurance, my God. That was years ago. I was an insurance broker for many years in Canada. I'm an external broker with them. So how it works is I would be your first point of contact and then I would contact with them. That way we both can get paid. Is that fair? Is that fair, my friend? Because it's thanks to me that Marcelo can be here today. Make sense?
It's 10 minutes walking from the beach, the closest location. The farthest location is 10 minutes walking from the lobby towards the beach.
Okay, awesome. Great presentation. Thank you. Do you have business cards and all that? Good. Okay. Good. Thanks everybody for attending in the restaurant and also online. And yeah, we'll be around. All the presenters will be around for a bit. So feel free to chat with us, ask questions. And we appreciate you all coming out today. Thank you very much to the Hive for facilitating our breakfast meeting today. And Bye for now.
So we went.